right, so we're going to get started now. My partner at the Philanthropy Project is John Pratt, and he's going to open with a few words and then introduce the panel, and we'll go with the panel. Okay, so over to you, John.
Great. Thanks, Jan. Well, welcome to our third in a series of 3 leadership briefings on reforming philanthropy, with today's focus on fixing philanthropy and the tax code. This third session builds on our first 2 sessions on private foundations and donor-advised funds. For first-time participants, the Philanthropy Project is a growing campaign that believes that U.S. charitable funds should be made to benefit the public. Much of the $1.5 trillion that has already resulted in tax deductions is sitting in repositories and subject to fees at private foundations and donor-advised funds instead of prioritizing the timely and effective uses of funds in active charities. So we want to get more of this money into circulation and to use the tax code in a stronger way. We believe that only appropriate government regulation and oversight can address the full scale of the situation, and welcome people to join this campaign. No event can be organized by a single person, so I also want to thank our event co-sponsors for helping get the word out: Cal Nonprofits, National Committee for Responsive Philanthropy, Nonprofit Quarterly, the Nonprofit AF, based online in Seattle with Voulet, the Center for Nonprofit Advancement in Washington, D.C., and the Minnesota Council of Nonprofits. This afternoon, we're pleased to hear from Ray Madoff and Alex Reed, 2 notable figures influencing tax-exempt law. And interestingly, each of our speakers has 2 law degrees each from New York University School of Law, both a JD and an LLM in taxation. Our first speaker will be Ray Madoff, who brings strong qualifications as a tax law expert in estate and gift taxation, inheritance, and charitable tax policy, and is a professor at Boston College Law School. Ray is also director of the Boston College's Forum on Philanthropy and the Public Good, addressing the tax rules governing charitable giving, foundations, and donor-advised funds. Ray has testified before Congress and is regularly consulted on estate taxes, charitable deductions, and philanthropy policy, and is author of the new book, The Second Estate: How the Tax Code Made an American Aristocracy, recently featured in a New York Times interview by Ezra Klein titled, Our Tax System Should Make You Furious. So we'll hear more about that. Next, we'll hear from Alex Reed, who is also well qualified as a legal and tax policy expert on charitable giving incentives, particularly on how the charitable deduction and other incentives operate within federal tax law. He's a partner and national leader in the DC law firm Baker Hostetler in their tax-exempt organizations and charitable giving team. He advises charities, foundations, universities, hospitals, and other nonprofits. He previously served as legislation counsel to Congress's nonpartisan Joint Committee on Taxation, advising members of Congress and congressional staff on tax legislation and policy. He also served as a fellow in the U.S. Treasury Department's Office of Tax Policy, giving them experience in the executive branch's analysis and administration of federal tax policy. Alex is the author of the treatise Taxation of Exempt Organizations and has chaired the American Bar Association's Tax-Exempt Organizations Committee. So we have 2 great speakers. Jan, I'll hand it back to you.
Thanks very much. So is everybody as intimidated as I am by those introductions? Let me just make a couple of framing comments before we get started. And so I want to ask all the people that are on this session today, did you pay income taxes? And I want to comment that if you did, like I did, you actually paid more income taxes than Tesla, United Airlines, or Taco Bell. So just to illustrate sort of the overall fairness of the American tax system. But I also want to say that I think a really important thing that Ray has said to me and to other people is that taxes are not complicated, right? We think that they're complicated, but they don't have to be. There's a zillion laws related to them, but also, as Ray says, the importance of the tax code in determining American economic life. In nonprofits, given the importance of the tax code to our very existence, not to mention a lot of the revenue flows for us, there is surprisingly little discussion about taxes. I just want you to think the last philanthropic or nonprofit conference you went to, and did they have a breakout on taxes and the charitable deduction? Have you read journal articles about it? Have you been to a convening on taxes? Probably not, but you have probably been on a million other different related topics. And I think one of the things is that we do see all the time nonprofits are always saying, this tax, your gift is tax deductible. Okay, you see that in almost every appeal. And particularly now that only 10% of Americans itemize their taxes, meaning only 10% of Americans can take advantage of that. Saying that your tax deductible has become less meaningful as an actual tax device and more kind of a form of virtue signaling, but it still remains kind of a cornerstone of how we think about nonprofits, is that donations are tax deductible. We also, when we do talk about taxes, we tend to focus just on the charitable tax deduction, but actually, I think other things, like the estate tax, capital gains tax, sales taxes. In many states, nonprofits are exempt from sales tax, not in California, by the way. And I think other issues related to specifics like charitable deductions for artwork, for cryptocurrency, for promising not to develop on land. And of course, no deductions for volunteer time, unlike, as Volunteer Match has long pointed out, unlike, for example, a bag of old worn out socks. So without getting into wealth inequality in general or corporate tax exemption for nonprofits or property tax exemptions for nonprofits, because those are important topics, but kind of today's focus, we want to focus on how tax law and the charitable deduction in particular drives and creates the behavior of private foundations and philanthropy in general. And because there's so much importance kind of backdrop to this, we've asked our panelists to make some short presentations to deliver as much info as we can in a short amount of time. So Ray, I'm going to hand it over to you and the share screen rule. You're muted, Ray.
Thank you so much, everybody, for being here. And thank you so much to Jan and John and Alex in particular. It's a pleasure to be on panel with you. This is a great organization and a great program. It's really wonderful to be here. Okay, so I've been allotted 15 minutes. I'm going to try to be really mindful of it. So I'm not going to talk about every issue, but I want to give some general discussion. So let's see if I can get the slide going. Okay, and play from the start. Okay, does this continue to share? Does that look right? Can't hear anybody else, so hopefully that is okay. I'll take a look at the chat. Okay, yes, that looks right. Excellent. Helen Flannery, thank you. Okay, so this section is called Fixing Philanthropy and the Tax Code. That was the title that was given to us. So I teach at BC Law School, and as a teacher, we have new rules where we're supposed to actually tell people what we're going to be teaching and then do it. So I will do that right now here with us. With the next slide. Okay, so here are our learning goals. One is, why do we have tax benefits for charitable giving? What are the tax benefits for charitable giving? Here is a little how our rules undermine charities, and finally, what can be done about it. Okay. The reason we have charitable tax benefits is to support charities and the beneficiaries they serve, basically to produce charitable activity. The charities play a critical role in American society, and many of the things that are done by charities in the United States would be done by government in other countries. And so charities do this essential work. They do education, they provide healthcare, they do the arts. Everywhere we turn, we see charities. Well, other countries might provide those things through direct federal spending. We do it through this interesting system where we subsidize are charitable donations. And we do it by providing tax benefits. Tax benefits enable donors to give more to charities than they otherwise would by providing a federal subsidy for their donation. So, for example, a person making a $10,000 charitable donation and who gets to pay $3,000 less in taxes, let's say they have a 30% income tax deduction, it is the same economically as if the donor had made a donation of $7,000 and the government provided a matching grant of $3,000. We've thereby reduced the cost of charitable giving for donors because the government has stepped in to provide a matching grant. There's a lot of values of this system. One of them has been written about by the Saul Levmore from the University of Chicago in an article called Taxes Ballots, which it says it basically aligns federal spending to reflect individuals' charitable preferences, right? So if we have lots of people supporting the Red Cross, then the government will provide lots of investment in the Red Cross. It also promotes pluralism, and this is a big advantage over direct funding by the government because it's a system in which we can each decide what types of things are in the public good and thereby can support all sorts of different things. It also allows the government to provide indirect support to charities, including churches, without requiring government to choose winners and losers and without having the support of the establishment of religion. So there's a lot of values of our system of these subsidies. However, there are some problems. The biggest problem for many Americans is the gross disparities in who gets these tax benefits. 90% of Americans get hardly any benefits at all because they give cash and they don't itemize their deductions. By cash, I mean they pay with money and not appreciated property, cash or checks. So for many years, they got no benefits at all. Under the 2025 tax bill, they provided a non-itemizer deduction, but it was only for the first $1,000. And so it was really a minimal benefit. So for 90% of Americans, they get no tax benefits. And yet with a well-planned gift, and these gifts typically are well planned, the richest Americans can get extraordinary tax benefits. And that's because of the many taxes that they can save. They can save not just income taxes, but if they give appreciated property, they can save capital gains taxes and estate and gift taxes. One thing I want to note about the problems of these gross disparities is if we think about the beauty of our system in promoting pluralism, now we're not promoting pluralism. Now what we're doing is we are heavily subsidizing the gifts of the richest Americans while other Americans get no governmental benefits or hardly any governmental benefits for their charitable giving. How much can somebody save a well-planned gift? Well, imagine somebody who gives $10 million of appreciated property. Let's say it's fully appreciated. They bought it for hardly anything. It's worth $10 million today. When they donate that property, they get to avoid capital gains because this is not treated as a realization event. So that saves up to $2 million in savings. They can also get an additional $3.7 million of income tax savings. And on top of that, they can get additional estate and gift tax savings. And the total savings can be worth as much as 74% of the charitable gift. Or in the case of this $10 million gift, we can have tax benefits that are worth as much as $7.4 million. What that means is that as an after tax, when we calculate these benefits, it is paid only 26% by the donor and 74% by the rest of us in the form of foregone revenue that otherwise would be provided to the federal government in many situations. Okay, who gets these benefits? Well, the income tax savings are only for people who don't itemize. So that means people with deductions greater than $32,000 per couple or $16,000 per person. Capital gain savings are only for those with appreciated investment assets, and estate and gift tax savings are only for those with assets greater than $15 million per person. And for each of these, the answer is the wealthy, the wealthy, and the wealthy. Basically, the wealthy are being heavily subsidized for their charitable giving, while most Americans receive hardly any subsidy at all. The second problem is that charities are increasingly unlikely to benefit from charitable donations. And here I want to take a little historical trip. First of all, many of you who read Giving USA have probably seen a chart that Al Cantor refers to as the most boring chart in the whole book. And it is a book that shows charitable giving over the past basically 45 years, and the charitable giving as a share of disposable income. You might have heard how charitable giving goes up every year. We're more and more charitable, but that's only because the stock market goes up. And if we actually look at the charitable giving as a share of disposable income, charitable giving has remained remarkably constant at about 2%, and now is even at a kind of historic low down at like 1.8%. So charitable giving as a share of disposable income has not gone up. However, where we do see a big change is where the charitable dollars go. In 1991, which is a year I'm going to choose because it is the year of the first commercial DAF, Fidelity Charitable, at that time, only 5% of charitable donations went to donor-advised funds and private foundations, and 95% went directly to charities. So remember, we're talking about pretty constant amount of charitable giving, but in 1991, 95% of charitable donations went directly to working charities. What's happened since then? We only have data from 2010 that covers both donor-advised funds and private foundations, but even from here, our numbers are kind of shocking. Look at this. In 2010, so 4% went to donor-advised funds, 11% went to private foundations, right? So the total amount was about 16%. And today, the total amount has gone up to 38%. And most of it, notice that private foundations have hardly increased at all, but most of this growth has been in the extraordinary growth of donor-advised funds. Now, of course, money doesn't necessarily just stay in these funds. Ideally, it will come out. But the problem is where law has abandoned us. The 1969 Act was designed to address this problem of money sitting in intermediaries and not coming out. And the answer and at that time, the only intermediary vehicle in town was the private foundation. And so Congress said, we don't want, we're concerned about giving current benefits with no certain benefit to charity. And their answer was to impose a 5% payout rule. And that 5% payout rule, is familiar to, I'm sure, many on this call. Oh, sorry about this. This is the amount that's currently set aside in private foundations and donor-advised funds. This enormous amount of money. But the problem for charities and society, as I was saying, is that there is no requirement for these funds to ever make their way to charity. Donor-advised funds are not subject to any payout rules, and while private foundations are subject to a 5% payout rule, payout can be met by paying salaries to family members and by giving to donor-advised funds with no further payout requirement. So what that means is that there essentially is no requirement for these funds to ever make their way out of the intermediary. There was a bill that was designed to address this problem called the Accelerating Charitable Efforts Act, a bipartisan bill introduced by King and Grassley. And it was designed to protect charities and restore legitimacy to our rules by ensuring that donor-advised funds made their way to charity and by preventing private foundations from meeting the 5% payout rule by giving to donor-advised funds. However, the ACE Act, I would say, died a fairly fiery death. And that was because of lobbying by the charitable sector. And when we say the charitable sector, what we have to realize, excuse me, let me go back. I meant to go back one. When we say the charitable sector, the problem is that the charitable sector is made up both of charities and of donors. And one of the things that happens is that the donors have a lot more political power than the charities. And the charities are afraid to exert their political power for fear of alienating their donors. And because of that political reality, the ACE Act, didn't achieve any of the things that we had hoped they did. However, and this might be in part because I'm an eternal optimist, so I'll put that out there. I do believe that what might happen in the future is really anybody's guess. And that's because as more and more money is being set aside into these charitable entities with no obligation to come out, and as the federal government is cutting benefits to states and to charitable organizations that were previously receiving direct grants from government, there is more and more pressure on charities. And I think we are going to see increasing attention there. And one very interesting place where I think we're going to see it is potentially from the growth of AI and the tremendous growth of DAFs that we are going to see if with these matching grants from AI companies going public. And I think there's going to be a lot of interest in making sure that these rules are actually serving the public and not just the donors. So with that, I will hand it over to Alex. Thank you.
Great. Thank you very much, Ray. So let's see, I also have some slides, so I might as well throw those up on the screen. And my basic message is not that what Ray is saying is inaccurate in any way, but that the frame in which we analyze these questions, I think has some problems. And because of that, the policy conclusions that we draw within that frame tend to result in policy recommendations that are not necessarily the best for the sector. So the frame that Ray is using and accurately using is the frame of tax policy, federal income tax policy. And it is the frame in which the charitable sector is customarily analyzed in Washington and elsewhere. So,
can I interrupt you for a second and ask you
yes,
to use slideshow so that we can
is it not visible?
they're just tiny.
I see. Thank you.
Thanks.
Is that working?
Not yet.
You want to say play slideshow, play from the beginning.
Yes.
It's usually view slideshow or something like that. Yeah. Well, okay. Well, maybe we'll just all have to. We can read it. It's just small.
Okay. Sorry about that. Okay. So the first point I wanted to make is, and this is kind of in the effort of reframing. So let's go back to 1819. So this is a case, Dartmouth College v. Woodward, and it's a let's see. It says my screen sharing is paused. I apologize. Dartmouth College v. Woodward. Is that better? Maybe that's
Perfect.
okay, great. Sorry about that. So in this case, Dartmouth College is a school that was funded by private donors. It's in New Hampshire, and there was an election in New Hampshire where the the a new governor was elected, and the new governor was a Jeffersonian Democrat. And the Federalists, who had been in control of New Hampshire, were also trustees of Dartmouth College. So the question presented to the court was, does New Hampshire, does the new Jeffersonian Democrat have the power to remove and replace the trustees of Dartmouth College because Dartmouth College is pursuing the public benefit, even though it's using private money, it's doing so in the public interest, and the government, the democratically elected government, also represents the public interest. Therefore, a democratically elected governor should have the power to remove and replace all trustees of Dartmouth College. So this case went up to the Supreme Court, and the Supreme Court said no. This is a private contract. The private contributions in the public interest are nevertheless controlled privately. The government does not have the power to control Dartmouth College solely because of the democratically elected leadership of New Hampshire. So this is a critical decision because it's what freed and made certain that American civil society is separate from American government, from state government and from federal government. So this is a kind of a key watershed moment in civil society and the history of American civil society. So then what happens next is you have the 16th Amendment. 1913, it's ratified. The 16th Amendment, very simple. The text is right there. It says, Congress shall have the power to lay and collect taxes on incomes from whatever source derived, without apportionment among the several states and without regard to any census or enumeration. So before this, the income tax was viewed as unconstitutional because it wasn't directly apportioned. And the only power that the federal government had was excise taxes on specific transactions, like a tax on whiskey or a stamp tax or something like that. But this says, no, we can raise taxes on your income. And that had the effect of anything that Congress could tax under the 16th Amendment, because it was income. If it is income, then it is within Congress's power to tax it. So if Congress chooses not to tax it, then Congress is subsidizing it, right? If they could have taxed it but choose not to tax it, then they're giving it back to you. And that is the frame that we've been analyzing the nonprofit sector under ever since. Right? So in 1918 is when the charitable deduction was enacted. No coincidence, 1918 was right around World War I, and Americans were very concerned about German U-boats off their shores and the need to raise money for war. And the tax rates were in excess of 70% in 1918. And members of Congress said, whoa, wait a second. Why would we sacrifice the very things that make us Americans to fight this war? What's the point of winning this war if we have given up who we are as a people? And they viewed the schools and churches and, these cultural institutions as so fundamental to the fabric of American society that taking those resources and sort of liquidating them for the war effort was an excess, going too far in the balance of power between citizens and the state. So they enacted the charitable contribution deduction. The income tax rates have floated up and down. You see they spike in wartime, and they've kind of leveled out to some extent over the past, since 1986, when the last major true tax reform occurred. And the frame that we analyze the charitable and tax-exempt public policy under was largely cooked and baked and set in 1986. I would say that the thinkers at that time, sort of developed many of these rationales that we still use today. So as a former staffer with the Joint Committee on Tax, I spent a lot of time with the public finance economists who estimate the revenue effects of different types of tax legislation. And my portfolio was the charitable sector. And so we talked a lot about it. And I was very alarmed to learn that they viewed it as a wasteful subsidy, the whole thing, the entire nonprofit sector, as a giant waste, which it is from an economic perspective. From their perspective, the federal government should simply take the entire sector. And the reason is that, first of all, if the government has the power to tax, it should use it. Right? If it's income, they should tax it. And secondly, if their intent is to provide a subsidy to a particular behavior, the most efficient type of subsidy is narrowly tied to the activity that you're trying to subsidize. The further away from that activity you get, the more waste there is in the system. And the charitable sector is very wasteful from that perspective, because every person can set up their own organization. They can pursue duplicative purposes. There's way too much play in the joints for effective, centralized government policymaking. So from their perspective, the whole thing is a waste, but I guess members of Congress like it, so we'll keep it. I found this very alarming and set about rethinking this whole thing, rethinking the frame in which we look at it, which is what brought me back to the Dartmouth case. And really, from my perspective and my project since that time has been to try to reground charitable public policy in the First Amendment instead of the 16th, where it currently lives. So in the First Amendment is about free speech, free practice of religion. It's about freedom of association. And we've had some recent cases that talk a lot about how important it is for people to be able to gather together and associate freely without excessive government interference. The other thing and that kind of analysis has led me to look back over the history of the regulation of the nonprofit sector through the lens of the First Amendment, and find a lot of very troubling facts that I'd like to just quickly remind everyone of. So, so this is a bit more about trying to rebut the argument of tax exemption as public money. The key point here is, if you think of this, the exemption from income tax of charitable contributions and the exemption from corporate tax of earnings by charitable nonprofit organizations, if you think of all of that as money that just truly belongs to the government, as identical to a direct payment by the government, the thing about a direct payment is that the government has the power to compel the recipient of a direct grant, to compel them to say whatever it wants to. So, for example, if you receive a federal grant and the federal government says you may not speak about abortion, then you may not speak about abortion using those funds. That's constitutional. That is not a violation of the First Amendment, because you took the money and you didn't have to. So government money that is directly given is entirely controlled by the government.
So Alex, I just want to ask you to speed up a little bit, okay?
You got it. You got it. Sorry. All right. So let me go through and oh, sorry. I have some okay. So this is going back to the reason why legislative speech in nonprofits is restrictive. goes back to Margaret Sanger, the founder of the American Birth Control League, who tried to legalize birth control. And she was told that legislative speech is incompatible with charity. Therefore, to this day, nonprofits are not allowed to engage in legislative speech. They're allowed some de minimis amount. Private foundations are allowed zero amount. In the 50s, Edward Rumley criticized the New Deal, and the Congress tried to get a list of his donors to find out who was funding him. Ultimately, the Supreme Court said, sorry, you can't find out his donors. And that was the first case involving the freedom of association. But Senator Johnson said nonprofits, C3s, can no longer engage in political speech in order to shut this man up, Edward Rumley. And to this day, nonprofits are not allowed to engage in political speech. That's the Revenue Act of '54. And we had the McCarthy era, where nonprofits engaged in promotion of communist ideals were blacklisted and sanctioned. Then in 1954, you had Brownlee Board of Education. Desegregation efforts in schools began. 57, you had the 101st Airborne helping to integrate schools. The Freedom Riders, funded by foundations like the Ford Foundation in 1961, engaging in direct action to desegregate lunch counters in the South, et cetera. The free speech movement in 1964.
Alex, 1 minute.
Yes.
1 minute, please.
1 minute, you got it. The Huff Street riots in 1968, which resulted in some voter education and registration efforts funded by the Ford Foundation, and that resulted in the election of the first Black mayor in the United States. Wright-Patman vigorously opposed to these civil rights movement and cited nonprofits as the cause of them. And the '69 Act, enacted by Southern Democrats to slow or stop the progress of civil rights in the 1970s, signed by Nixon in '69. The 1969 Act imposed the 5% distribution requirement, prohibited certain transactions, and involved a great deal of censorship to blunt the power of nonprofits. That's what I wanted to share with you.
Thanks, Alex. I hope I'm not cutting off too much of you. Okay.
No, you're fine.
All right. Thanks very much. So it's I thank you, Marie, for your point about appreciating the historical context, and anything that has a picture of, people in black and white drawings being gagged always is going to be a great slide. So, but I wanted to say, like in our past two webinars, the one that we did on foundations and the one we did on donor advised funds, we've looked a lot at addressed solutions to kind of work on the issues that both of you have identified here. And some of them are some of those ideas, for example, are at play. Like, for example, the current idea, right, of expanding the IRA charitable rollover to make them to be able to DAFs to move their money through those kinds of vehicles. But so I wanted guys to turn a little bit away from the question right now of analysis, right, and more to the question of kind of reportage or journalism. So, Ray, you were so involved with the ACE Act. So one of the questions we do have in the Q&A I think is important is there legislation like the ACE Act being proposed anywhere, or what are you hearing about people kind of drawing something like that together again?
I think that one thing that we have to realize is about the reasons where charitable reform is easier and where it's harder. And I think that the answer is no, there's no current legislation that's going on right now. That's the shortest answer of that. And maybe that's enough of an answer for you for now, given our shortness of time. But I do think that I do think that the way the charitable sector is going, with growing awareness about these extraordinary disproportionate benefits for the wealthiest Americans, I think that there is the possibility of reform in the future. And particularly when there's going to be so much money flooding into DAFs. I just heard that from OpenAI and Anthropic alone, it's expected to grow $300 billion in DAFs just from those two IPOs, because those companies are providing matching grants for people to give. And because they have to give their IPO stock, the only way they can get their tax benefits is to give to a DAF and not to a private foundation. So there is going to be an explosion of funds into DAFs, and the idea that we're providing tax benefits with no assurance that the money will ever get to charity is absolutely absurd. And I do want to follow up, which is one little just a little amendment to one of the things that Alex said. Alex, you talked about the 1918, the enactment of the first charitable deduction. That came about because schools were concerned that when you raised the charitable deduction, rich people were going to think they had given to society. I'm sorry, when you raise taxes, rich people are going to think they've given to society, and if by doing that, and they won't support colleges anymore. And the answer was, fine, we will provide a tax benefit for up to 15% of your taxable income. It was extremely limited. It was not an unlimited thing to promote the flourishing of all nonprofits. It was very narrow, and it was in response to the schools that came to Congress and drew that out. So I just want to add that.
So Alex and John, do you both agree or disagree with, Ray's assessment that there are some stirrings about changes in tax policy, especially the charitable deduction? Or what is your thinking about it? Alex, you're in DC, you're among all of us, so you must be breathing the air. What is your thoughts on this?
Well, this has been quite a couple of years of intense scrutiny of the nonprofit sector. Certainly political scrutiny of the nonprofit sector. Organizations that are oppositional to the agenda have been marked for retribution by the administration and subject to executive orders. I view that as entirely part and parcel of directly in line with the whole history of this, and I would not be surprised to see those viewpoint restrictive agendas transmitted into tax policy that seems neutral but actually has the effect of blunting the power of the nonprofit sector. We also see the public money argument vigorously used in the House Ways and Means Committee oversight of nonprofit hospitals, fiscal sponsorships, and others. They say, this is our money, federal government's money, and we're not getting the benefit of our bargain. We want more of this or more of that. There's sort of this entitlement that Congress can do whatever it wants. It can condition the charitable exemptions and exclusions on anything that it would like to.
But it is Congress that makes the laws, the tax laws. Is that right?
Yes, it is. It is Congress. And when you ask Congress how much money it would like, the answer is more.
John, do you agree about the prospects for changes?
Well, I think, if you look at the whole system of, both tax laws, and they're trying, Congress their job is to raise the funds and allocate the funds, but they're dealing with a changing economy. And I think that's the hard part is we look at charitable giving, Ray's chart showing that as the percentage of money, charitable contributions going to private foundations and DAFs has gone up, at the same time, so the percentage left for active charities and, the United Ways and Human Services Arts has gone down as a percentage, but at the same time, fewer Americans are making charitable contributions. So we've seen sort of a gradual erosion of the donation base, especially among small and mid-sized donors, which aren't seeing the incentives. A study survey done by the Wise Giving Alliance, affiliated with the Better Business Bureaus, they do a regular donor trust report, and donors are reporting, the small and mid-sized donors, that their perception is, well, yes, we are giving less, but we think the bigger donors should give more. But this is really kind of skewing the kind of participation that, Alex, you were promoting, that, a democratic society where everyone gets to participate
Yeah.
and has a right to. But the challenge is going to be, you're going to have a top tier who are the agenda setters, who are basically setting the agenda for the nonprofits and society. And the question is, how do we adjust to that change in the economy? And can the tax laws be written so that average donors get the same kinds of benefits that those high-end donors now get?
So, I feel like Alex and Ray, you both focused on critique. So what, if you were to say, what are the laws you would propose, right? Can you say succinctly what two of them, what changes to the tax code you would like to see, that you would like to see this audience, for example, take up?
You want to go first, Alex?
Sure. Well, so I think that much of the regulation should be repealed, and we should start over, because I think that it is sort of a tapestry of old battles that everyone's kind of forgotten what we were even mad at back in the day, and that over time it's a one-way ratchet of restricting nonprofit power and influence that ultimately ends in catastrophe. So I see the trajectory as very pessimistically, and I would start fresh, focusing on prohibiting private benefit, right? So we don't want people stealing money from the sector, and we want to encourage public benefit. That's really the only two parameters that I would put on it.
So kind of my understanding is kind of enforcing some of the current laws, which may not be really being enforced, about loopholes and that kind of thing.
Yeah,
right?
private benefits to be avoided.
Yeah. Ray, what are your thoughts?
I think that we have to realize that the charitable sector has been a place where abuse has occurred. And one thing I'd like to talk about is what gave rise to the '69 Act. Yes, the ultimate legislation was affected by anger at the Ford Foundation, but the motivation was spelled out far before in Treasury reports and in the 1950 Act. And the concern was that once we had the charitable deduction and we had high tax rates, people were creating charities, their own Joe's Charity. They were putting in their businesses, they were running, so they were deducting everything, they had it all tax-free, and it was a big tax scam that allowed people to use the charitable sector for private benefit. And that's why we enacted the 1969 rules that ensured that there could be no self-dealing if you were creating Joe's Charity, as opposed to, the Red Cross. These rules were designed for a purpose. And the reason we had the payout rule was that we were concerned that when donors controlled the funds, they might not spend it for charity. That's why we had a payout rule. And I think the payout rule was important if we care about charities. And I think that it's important that we make sure that donor advised funds are not just an end run around those private foundation rules, which is how they operate today. And I think one place where Alex and I disagree is that I believe that there is a difference between working charities and what I will call charitable intermediaries, money that is set aside by a donor and functionally controlled by the donor, but not actually committed to any charity. No charity can use that money to feed people, clothe people, or do anything. I think that those two things are different and should be treated differently. I think Alex takes the view of it's all money set aside for the good, and those can all be treated the same. In the world that we live in, I don't want to treat them all the same because it's costing all of us an enormous amount of federal revenue. We're running annual deficits. Costs on the deficit are $1 trillion a year. And much of that has to do with these excessively generous charitable benefits with very little assurance. And I just want to make one more quote, which is that Warren Buffett, the much beloved Warren Buffett, said at one point that he believes that he does more for society by creating his charitable giving, which, by the way, is to his kids' family foundation with no requirement for the money to come out, but that's a separate point, that than he does by paying down the national debt. And my question is, who does he think should pay down the national debt? Why is it that all the rest of us, all wage earners, have to give more and more money to, keep our country running, and then we're giving a free pass for people just to set money aside? It doesn't feel right to me.
So,
To respond, yeah, if I may.
John.
Oh, go ahead, John.
So,
I hope you'll let Alex respond. I don't mean to attack and not give him a chance to respond.
well, I want to, we're almost out of time. So here's one thing. If we were to change the payout rate, right, for private foundations and or for donor advised funds, what would each of you propose that it be?
I don't think Alex thinks that we should have a payout rate. Is that right?
Yeah, I absolutely do not think we should have a payout rate. The reason that I think that is because, first of all, a payout rate is an interference with the internal governance of the organization. Secondly, all nonprofits are intermediaries because the recipient of the aid is not the nonprofit, right? If we use trusted intermediaries as the basis for civil society because we need some verification to know that charity actually takes place. And the trusteeship, the governance of those entities is where everything happens. That's where civil society exists, is in the governance and the prudence to decide, I spend today for this charitable cause, I save for tomorrow for that charitable cause.
Can I just answer?
Yeah.
Can I answer that question? Or no, sorry, Jan, you're telling me no. We're out of time. Yeah.
I appreciate the philosophical underpinnings of your thoughts about here, but I feel like in the real world, there does feel like there's a real difference between Meals on Wheels, right, and the Ford Foundation, in terms of what they're doing or in terms of a donor advised fund and a food bank.
Well, I guess the main point is that if you impose a payout, you will reduce money going into the sector, and that
only depends on how the payout's factored.
Right.
So Ray and John, what would you propose the payout be? Right now it's 5%, which includes things like payments to themselves, as we mentioned, and there's no payout requirement for donor advised funds. What would you suggest the payout for each be?
Well, I think at our first session on private foundations, Craig Kennedy, who's former head of Joyce and German Marshall Fund, suggested 10%. And I think as a starting point for a public discussion, that's a great starting point. And have this discussion. If there's no payout requirement, I think there's potentially no public benefit. And the same for the DAFs should not be a workaround. And they're being used as a dodge now. And something like 25% for the DAFs would also be a great starting point for how does this money actually get into public use, because it is clearly being abused right now.
Ray, what would you suggest?
I agree. I think we need to have a payout rule. I would say that we have to recognize that I would stick with the 5% because it's justified on this theory that somebody wants to preserve something in perpetuity, we should let them do it. So I'm fine with that. But let's have it be a real 5% and not pay family salaries and not have it do an end run by giving to a DAF. If we're going to have that, then get rid of the rule altogether. For donor advised funds, I think we have to recognize that donor advised funds get more tax benefits than private foundations because they are structured as a public charity, just like a food bank. We give these added benefits, and the reason they're able to do it is not because the money's controlled by trusted fiduciaries. It's because it pretends it's being controlled by trusted fiduciaries, but the only reason people give money is because they know they can control it. When I give my money to Fidelity Charitable, it's not because I count on Fidelity Charitable to spend my money. It's because I know they're going to let me do what I want with it, and if they don't, I can take it to another donor advised fund. And that's the reality. So to pretend it's controlled, that it's a legal fiction because the reality is operating in another place.
Well, I think that the trusteeship is quite important, and it does exist just as trustees
They
of
don't exert their trusteeship rights. They
they
defer to the
certainly do.
donors.
They prevent the use of funds in donor advised funds for crime. They prevent it from being
Right?
used for illegal purposes and
But they
not.
don't decide that they need more money for food banks.
But
They
so
decide that that's a donor question, which charitable cause to support.
Ray, though, so you in the past you've suggested that instead of having a payout rate for donor advised funds, that the tax deduction be delayed until the
Yes.
money.
And that was, but the preferred way was to say that you get some benefits when the money comes in. So you'd get to save your capital gains and you would get to avoid gift taxes, but you'd get the income tax deduction when the money came out. And that would more closely track the purpose of our charitable deduction. By the way, the basic rule of the charitable deduction is that you only get the charitable tax benefit when the donor gives up complete dominion and control. That's the tax language. And it's because it's only when the donor gives up complete dominion and control that a charity can do its work. And that's why the private foundation was seen as a problem, because they pretended to give up dominion and control because they were just controlling it through controlling the private
And then they
foundation.
engaged in civil rights activity.
No, it's not about civil rights activities.
It
That was one of the
it
things that
actually
got it
is.
over the edge, but not
Right.
the
That's what
purpose.
Congress cares
Look
about.
at the IRS report, the Treasury
Look at the
report.
Congress's reports this year. This is what they care about, is preventing people from interfering with vested political power.
Your restrictions would actually allow people to use charities, the release of the Johnson rule, to use charities for political spending. And so tax benefits. So now I'm subsidizing somebody else's political
I do
spending.
believe in free speech. Yes.
I
Okay.
believe in free speech, but you don't need to be paid for it. You can be free speech on your own money.
So I just want to say that I believe in free speech, I believe in payout rules, and I believe in ending on time.
You're here.
And it's also, I
Thank
have
you.
to say, it's also been a pleasure not to be the person who's ranting the most on any given session. Thank you, both of you, for outdoing me on the rant control thing.
You're welcome.
I wanted to say that, these three sessions are informing us at the Philanthropy Project in developing a policy agenda, as well as kind of a path towards getting towards that policy agenda. So, thanks you two very much for being with us. And John, John, give it back to you for the final words.
Sure. Well, and thank you to our co-sponsors who helped get the word out. And as Jan said, the goal is to identify ways to have a productive conversation and ultimately develop a public policy agenda that nonprofits need to know about and ultimately we want supported. This Congress is not active in positive ways on this set of issues. Ultimately, there will be a Congress that can hear this, and we want to be ready for that. Thank you for everyone for participating. Thank you, Jan, my co-chair, and thank you, Jan, and Alex, and Ray.
Thank you so much, everyone. Thank you, Alex, Jan, and John.
Likewise. Take care now.
Goodbye.